Good morning. Good morning. Welcome back. Those of you listened in on the conversation with Minister Mantas. I was unduly polite. My wife even made me put on a jacket, but she couldn't get me to put on shoes. Now we talk to international investors. I'm not a CEO. I don't care what they think. I can be blunt. But Fiona will be the voice of reason between us and them. Fiona, welcome back. Welcome back to the Joburg Indaba, and welcome back to this topic and this panel with our international investors. We are getting lots of questions, so I will definitely take up the full allotted time at the end of it. Can I ask you to take away the conversation? Over to you, Fiona.
Yeah, thanks, Bernard. And thank you to our international investors. I'm really thrilled today that we've got two fresh aspects that probably we haven't had before. One is that we've got an equity investor in the top equity investor in the form of Olivia from BlackRock, who is not only doing the traditional mining fund, but she's runs a circular fund now, so a circular economy fund, very much into the field that we were talking about yesterday on energy transition. But in addition, some fresh perspectives, because we've got Brett from Resource Capital Funds, which is a mining private equity fund. And to be blunt, they can't just sell their shares if something changes. They're there for the duration until they can find an exit, and that brings a fresh perspective. And thirdly, Mick McMullen, who, if you read his bio, has worn a number of hard hats in this sphere. And most interestingly and most recently would be raising a SPAC in New York to invest in a mining asset. And also for those of you who are keen Sibanya funds, he was at Stillwater. So it's really a very, very interesting spread we've got. The three broad areas we're going to look at. So let's start on the first one, which is, where are we in the traditional cycle of commodity prices? And our program suggests maybe this isn't a traditional cycle. There are lots of other things filtering into that. But basically, to the speakers, the audience would like to know where we are in the cycle and therefore where we are going from here. So may I start with ladies first? Olivia, any views on that?
Yeah, thanks, Fiona, and thanks everyone for being here. Look, I think the first point we should always make on this is that commodities are cyclical. Maybe some people forget that, but most commodity cycles tend to last somewhere between sort of 3 to 5 years. And if you look back at other major cycles, like coming out of the late 90s, coming out of the global financial crisis, coming out of the 16 lows, the cycle that we're in right now, the sort of post-COVID cycle, is actually tracking very similarly in terms of both the equities and the actual commodity prices themselves. I think, though, what is different about this cycle, and I think this is going to be really interesting, is that we're going to this period of stronger demand following a period of underinvestment into the space. And so I think there is, for a number of the commodities, reasons to suggest that the cycle could be longer. And I think another factor that we've also got to think about as well is how do we incorporate ESG into this? Because ESG obviously is changing probably the demand profile of commodities, but it's also making it much more challenging to bring on new supply. So I think there are a number of reasons to suggest that this cycle could be longer than a typical cycle. But from where I'm sitting, right now, I'm really encouraged by the way the commodity prices are generally trading.
Thanks, Olivia. Brett, really from sitting down under, not so much down under for the South Africans, but certainly for London, how do you see the outlook, where we are, where you think we might be going, and whether all of the metals are going to be correlated in this cycle, or whether there's going to be a divergence?
Thanks, Fiona, and thanks, Bernard, too, for the invite. And I think I'd probably start with your comment around commodities being aligned. I think we're seeing a more traditional cycle where the commodities are a little disjointed. Precious metals have certainly underperformed relative to some of their peers in more recent times. But I think the most optimistic we see things is in the base metals and industrial minerals, where it's more of a early growth phase. And I say early in the sense that, despite some really impressive incentive prices, we're just not seeing a reaction from the market in terms of gearing up for new development in those areas. So, to Olivia's point, we do see the cycle lasting a bit longer, given that we're just not seeing the reaction in these early days. So those willing to be bold and take risk at the moment will certainly be rewarded the most. But I fear for the standard mining cycle where we wait too long and a lot of money is put to work in the wrong areas at the wrong time. So it'll be an interesting few years with plenty of volatility, Fiona.
In other words, they could go up or they could go down. Thanks, and Brett and Mick. From your perspective, so you've raised money for a SPAC. How do you see planning, timing, cycles for you to invest that money? Where and why and how?
And look, thanks for the invite as well. So we probably see a bit of a split cycle. Iron ore's obviously been very, very strong. But anyone who knows Western Australia, you could probably dig up my backyard and make money at $230 a tonne for iron ore. And realistically, I don't think anybody actually thought that was going to carry on, and it hasn't done. But the other thing that we see is that there is a strong structural push from governments now. So it's not just industrial demand that is driving the cycle. It is this decarbonisation theme, which has been trucking away in Europe for a while. But all of a sudden, North America and China have really got behind this. And that is what's going to drive much of the cycle for the next, 3 to 5 years in whatever you want to call them, green metals, future-facing metals, any of those names. It's actually government policy that is driving that cycle right now, as opposed to a sort of an underlying supply-demand from industrial usage. So the way I look at it is that this is not all boats get lifted up by the same tide cycle. I think you're going to see, and Liv would know this, that, a very much a differentiated cycle. That doesn't mean there won't be opportunities in gold. At the moment, you can't give gold away, gold equities away for love nor money, but that doesn't mean that there isn't some good opportunities in that. But if you're looking to raise money, raising money in future-facing metals, forward-looking metals, you can raise almost any amount that you want.
Yeah. Thank you. So just two questions flowing from that. In your SPAC, did you have to specify a particular area that you would invest in?
Yeah, we didn't have to, but we did. So we said, look, our focus is metals and mining, excluding coal, because there's just too many investors who can't touch you if you can touch coal. And upstream and downstream. And, we were chatting earlier about, the downstream part of the business. And obviously I ran Stillwater. We had a huge recycling business there. Some of our other team have run large downstream businesses as well. We really like downstream businesses. We think they're a great business to have. And so basically we said we'd do anything, but our investors have a strong, strong preference for something in future-facing metals.
Yeah, the critical metals. Yeah, great. So two things have come out of that. Just to throw back to, I suppose, the relatively positive view that we're getting on the commodity cycle. The first thing is two things that could possibly derail in a small way. One is China compared to previous cycles. If I think of the 70s, 1970s, 80s, 90s, even before the super cycle, China wasn't as important to the sector as it is now. So are there any concerns around the property sector Evergrande sending waves through the market that actually China might be out of step economically with the rest of the world and therefore put a bit of a dampener on commodity markets? So, Brett, any views on that?
Yeah, I think we'd probably downplay China more so from a demand perspective this time around relative to the last big boom. 10 or 15 years ago. I think what's really different this time around is what China's done and positioned itself in the global manufacturing chain and how important it's become. And I think you covered some of this in your session yesterday. But China's going to be calling the shots around sort of downstream margins for the foreseeable future. So I think there's demand across the planet. But in terms of how that material gets processed, China will continue to be a very important player in that part of the industry.
Yeah. And so the second really very big topic that comes out is inflation. So where this might derail the current cycle. And this is in two parts, because I think you've already indicated, and I'm going to get you to talk to that, what you're seeing in terms of inflation in the mining sector itself. But I had a very interesting response to my panel yesterday from somebody whose opinion I respect enormously. And his view is that the energy transition is not going to go smoothly. It's going to disrupt supply chains and in fact could cause big pockets of inflation to bubble out, like gas prices, if it's not all managed smoothly. So that's a big topic, inflation. Olivia, can you, how do you see inflation possibly feeding into this cycle and what effect it might have?
Yeah, I think the whole inflation debate at the market in the market at the moment is really interesting. It seems very much that the consensual view is that this inflation that we're seeing is largely transitory. But if anyone who is trying to build a home, trying to get goods around, looking at supply chains, it's much more than inflationary. And I'm a believer that we are, going into a higher inflationary, higher capex cycle than where we've been in the past. So that naturally should be providing a nice tailwind for some of the commodities. But I think that the real focus at the moment is, particularly here in Europe and also in China, is what is happening to energy prices and what are the kind of some of the maybe unintended consequences of this energy transition, where it isn't necessarily smooth sailing. There's a huge amount of investment that's going to be required to go into renewables over the next 1 to 2 decades, and in that period, we are having this scenario right now where power markets are very, very tight. That is leading to natural inflation. And I guess the broader risk that you could have it around this is that you move into a period of stagflation, and that would be really quite bearish for markets. But I'm a believer that, we are going into a period of higher inflation. I think particularly when we look at those commodities that are important for the energy transition, I think there's going to be a huge amount of demand. There's supply shortages for many of these commodities, so you can see them really benefiting from that. And I think the other thing which is quite interesting for some of these commodities is that they're not particularly price elastic. When you think about, who is spending this money around decarbonisation, it's largely government backed. And I think that the price elasticity of that spending is also quite a bit lower.
Mick, if I can ask you to comment on another aspect of inflation, and that's the gold market or the precious metal markets. You could have two arguments there, that inflation traditionally has been good for gold, but on the other hand, we're coming out of a period of such a long period where interest rates have been suppressed artificially, and moving out of the tapering is unsettling people in the gold market. So any views on how inflation will impact the precious metals?
Well, as you say, traditionally, a bit of inflation's always been good for gold. Interest rates really can't go any lower, though, at the moment. But I wonder whether, the central banks really can afford to put interest rates up very quickly at all. Just given the politics around the world at the moment, the minute you start putting interest rates up, your stock markets are going down. Your average American has borrowed a lot of money. Housing market's going well. Politically, it's very hard for a US government to see interest rates go up. Usually not so good for your long-term political future. So look, at the end of the day, I don't see gold collapsing from here. It's still a very healthy price. If you can't make money in this gold price environment, you probably shouldn't be in the gold business. Can I see it running up hard? No. Look, I'm not someone who believes in, the gold price is going to be $2,500 an ounce. I think the biggest challenge gold miners have got now is controlling their input costs, particularly with fuel, the big open pit guys, and actually ensuring that they don't see their costs running away. And again, if you're in WA, you're probably seeing 25 to 30% annual cost escalation. If I sit on the board of another gold company with operations not in WA, we're seeing relatively modest, benign cost escalation at this point, except for fuel. That's really the big impact.
Yeah.
So for gold, look, I'm a bit of a half glass full, half glass empty sort of message, I guess. I just don't see gold running hard, but I also don't see it collapsing.
Yeah. In other words, Goldilocks scenario. Somewhere in the middle, yes. Brett, just to finish on the cost pressures, we've talked often at Rothschild about how the commodity prices can go up and everybody gets excited, but the margin remains the same because the cost follows. So you had some interesting comments on what you're seeing on cost increases.
Yeah, no, for sure. I think we've seen a couple of gold assets, particularly here in Western Australia, that have been like development assets that have been shelved. They're failing to sort of control their capital costs and ultimately just can't get the people, regardless of the cost. So, we are seeing some of those less attractive assets sort of being shelved earlier than anyone would hope. I also sit on a board where we process tantalum and move that material around the globe. Even things like moving containers around on the ocean at the moment is presenting to be a real challenge for us, and that has an impact on working capital. And we're flying material at the moment, and outside of COVID, flying material wouldn't be that much of a challenge, but there aren't consistency of flights around the world either. So the supply chains are very challenging for lots of companies, and I don't think anyone should be thinking this will be resolved anytime soon.
Yeah. So thank you. That's really excellent background on the sector. So if we are sitting as the head of a big mining company or a small mining company, really, what should our strategy be for the next few years? Should we stick like the majors have in returning capital? Should we be investing in growth? Should we be getting less risk averse in terms of going to new countries where some of these critical metals are found? So what would you be advising companies to be doing in this environment? Olivia, I know BlackRock are great at pulling no punches with a company.
Fundamentally, what a company should be doing is looking at the best way that they can create value for shareholders over time. In the markets that we've been over the last few years, when we've had oversupply in a number of the commodities, returning capital to shareholders has been a great way, when you look at that compounded over time, to generate returns. I think we're now sort of moving more into a phase where we are seeing demand improvements. Commodity markets are really quite tight across some of the commodities. So there is, I guess, more justification for some spending into growth. But once again, if you're going to be spending money on growth but generating suboptimal returns, that there's really no value being created there for shareholders. So for me, it's all about maintaining the focus on the capital allocation plans that were outlaid a few years ago, focusing on those returns to shareholders. And if it's the right thing to do, then yes, growth may make sense. I think the other thing that's really important for the companies, we haven't really spoken about this yet, is making sure their own business is prepared for a lower carbon world. There's a huge amount of focus going on with the companies at the moment in terms of lowering their own scope 1, 2, and in some cases 3 emissions. And for some, that can be by just sort of natural investment that's going on into the grid and transferring that to renewable energy. But for not every company, not all assets, that's not necessarily possible. So I really think that if companies are not being, really leading and at the forefront of this ESG change that's going on, they will be left behind. And the investor pressure to make sure that companies are operating in a sustainable manner is very, very strong. So I think that to me is quite interesting when you think about the capital that will be deployed into that area as opposed to just growth. That's quite interesting in how we think about, supply coming into markets for the commodities over the next few years as well.
Yeah, new way of absolutely dominating, new way of thinking. Thank you. Brett, in terms of capital allocation, one of the issues around moving into the critical metals and investing in that space, where in theory, I'm sure shareholders would approve. In practice, the variation, it's so many moving parts in trying to value a project in these fields, because prices, production costs, all of those are almost impossible to predict. How do you value and work out whether you should be investing in some of the projects in the newer critical metals?
Yeah, Fiona, it's a really challenging element of that market. There's a huge amount of R&D going into end uses. So battery technology seems to be changing year on year. And to try and build a mine that would take 3 or 4 years to get into production and really hit its straps after maybe 5 or 6 years, and then find out your markets sort of changed, your end markets have changed again in 3 or 4 years' time, is a really difficult thing for at least us to get our head around. I think we fundamentally believe in the industry as a whole. What's challenging is tying yourself to any one particular commodity. So, we're more comfortable with the likes of nickel and copper, where we see, greater diversity of use. But to sit there and put your name behind a cobalt or a vanadium or anything else in those particular areas is really challenging, and not for the faint-hearted. So those that do their homework and have conviction and move early will be rewarded. But it is for the sophisticated investor to some extent, and the big players.
Yeah, okay. So question mark on the big players. Mick, moving to you, the big players, what should they be doing in this environment?
Well, look, I think they should, again, as Liv said, they should be sticking to their plan of, capital discipline. They should be ensuring I'm a very risk averse person, so the first thing they should do is make sure their balance sheets are very strong. Bulletproof would be the way I'd look at it. And start dipping their toe in the water of some of these, new metals, like not a traditional copper or nickel, but, your lithiums and rare earths and stuff. Because I think fundamentally, investors want to see that. They want to see that they've got some exposure. But as Brett was saying, right now, those stories, they're not dividend yield stories. They're really about the future. That's the equity story. The equity market's going to give you that higher valuation, but there's no meaningful, EBITDA multiple that these things trade at, because they often don't have any EBITDA. So I think that's what, larger companies and sort of medium-sized companies, make sure your balance sheet is solid first. Get your business in order, and then start dipping your toe into some of these other things, which, Neil over at Sibanye Stillwater has done that with, he's bought a nickel refinery. He's bought or farming into a lithium deal in Nevada. He was an early mover getting out of South Africa by buying Stillwater. And now you can see he's an early mover into the, the future-facing metals, right? So small bets for him, but, if they pay off, it will give his company a differentiation versus the other, traditional South African mining companies, I'd say.
Yeah. So what we're hearing is I think what slightly worried the speakers on the panel yesterday, which is nothing's going to change fundamentally in terms of the investment in the green economy if we are urging the big companies to still softly be careful. We still want our dividends. Isn't it time to say to the big guys, like we've seen BHP dipping a toe in, actually, go for it now, go to the risky places. Otherwise, China will lock them up. Otherwise, riskier companies will get a hold on these assets. Isn't it time to be urging them to be more aggressive? Olivia.
Look, once again, I don't think my view on this changes hugely. I think we've really got to ensure that investments that are being made do result in returns to shareholders over time. I think there's absolutely a lot of merit behind this sort of concept around creating options, particularly in some of these future-facing metals, and that will probably gravitate to a need to go into higher risk locations, to take earlier stage options. But I think, in terms of, paying huge premiums at the top of a cycle for assets, I think we've been down that story, that road before. So I think management teams have a much more prudent value focus when doing this. But I think in terms of being, ignoring this kind of changing of commodity demand through time and the areas that are going to see the same growth, the highest amounts of growth is wrong. And that's why you're starting to see, the big companies are beginning to dip their toes into new areas. And I think we'll also see through time that, once we've seen success of some assets in higher risk jurisdictions, maybe the majors follow. Maybe I think once we prove that you can operate in these regions, that you'll start to see more investment there, and actually these countries do not become as risky as what they were in the past.
Yeah. Great. So I'm conscious that the time will run out before we know it. We're talking to an audience in Johannesburg, so please, all of you, particularly those two down in Perth who have an interesting perspective on South Africa as a mining jurisdiction, can we just address the issue of South Africa hasn't got nickel, it hasn't got a lot of copper, it hasn't got necessarily tin, tungsten, etc. It's got a few of the critical metals. And it's got coal-fired energy sources when they work. Can you just quickly give a view on how best the South African mining companies can ensure they're on the right side of short and medium-term developments? Mick has already referenced Sibanye, which is a very interesting example, but could we go to Brett on this, please?
Yeah, I think the key one, Fiona, is exploration. A country like South Africa has great geology, has great infrastructure, and I think a pipeline of new projects will attract capital investment at the end of the day, and they're currently thin globally in terms of where the demand sits, and exploration drives your service industry and it captures your human talent within the country. So that may not be a short-term fix per se, but at the end of the day, if you aren't continuing to replace those assets, the medium term looks quite challenging. And I think at the end of the day, you have to have a reasonably reliable place to permit, to be able to interact with on a social perspective with your communities and have a reliable regulatory environment. So places like the US for us, are a very challenging place to build a mine these days, and we've seen those countries relying more on allied countries to provide these raw materials, and South Africa has a part to play in that. But it needs to be able to demonstrate that it is that reliable partner and attract that capital.
Yeah, very good, very interesting. Mick, your views, please.
Look, I think South Africa, echoing Brett's comments, huge mineral endowment, and you don't, like in WA, a lot of these lithium plays now, no one ever thought to assay for lithium in the past. You've got lithium assets in Mozambique and you've got lithium assets in Namibia. So, for sure you'll have some lithium assets there. You do need a stable environment. And I suspect that in the short run, the bulk of how South African mining companies can do something about this is it'll be outward investment, just like Sibanye. It will take a fair bit of time to generate projects in South Africa and for the political system to mature sufficiently to provide that stable system that, can attract large amounts of capital, because some of these future facing materials such as, rare earths, even lithium, you're talking big capital numbers to develop some of these things. You know, like a decent sized rare earth mine, Mountain Pass in the US, I think it's had 1.7 billion US tipped into it and going. People aren't going to put that money in for, you know, unless they have certainty there.
And on the energy side, do you see any opportunities for green hydrogen, you know, with all those deserts and Karoo's and things?
The Karoo's a pretty sunny place. Where I grew up in Western New South Wales has got a lot of solar energy now. You know, my wife is South African, or was South African. I've driven through a lot of that part of the world there. You know, it's pretty windy in places. So there's no reason why you couldn't have, you know, green energy. We've got a green energy, you know, proponent here, green hydrogen in the form of Twiggy. I guess, you know, love him or not like him, you need a Twiggy.
He's an early mover, yeah.
You need a Twiggy type person in South Africa to really push this along, right? And there is absolutely no reason why South Africa couldn't get behind that. And obviously with Eskom, you know, it's been a bit challenging. So you know, a rethink on the whole energy system in South Africa could potentially unlock a huge amount of investment, inward investment.
Great. And Olivia, I can see Bernard appearing, so a one-liner-ish.
Yeah, look, I think I've always thought of South Africa as a country that is hugely rich with resource endowments. I think, you know, for me, I think a lot of these companies are going to have to go back to exploration, because there's just been a dearth of exploration over the last decade. And so I think, you know, I am sure that, you know, you will find the commodities that fit for this next wave. But to the point that I think both Mick and Brett were making, it's all about ensuring that there is that fiscal stability in order to actually incentivize and give confidence to teams to actually invest the capital for the long term.
Yeah.
Because once you start to think the capital is there.
Yeah, absolutely. Thank you so much, guys, from my side. And hand over to Bernard for, I'm sure the audience has questions.
Yeah, thank you. I really found that very interesting. And it's obviously wide-ranging, and so the questions also are wide-ranging. Olivia, I want to come back to you. So I think you made a statement about, in the long term, creating value for shareholders is the best way for a company to create value overall. And I know you don't say that to the exclusion of other mega trends, including ESG, and especially BlackRock is at the forefront of ESG. So, I mean, obviously, in that definition of creating value for shareholders is fully captured all the other societal and ESG factors. You want to just perhaps pause on that point a little bit?
Yeah, I mean, I think actually, you know, ESG is a huge sort of growing area for a lot of investors. But I would say actually the mining sector has always done a lot of work around ESG because it's an extractive industry. Safety is a huge focus. You can often be operating in more challenging locations. So I often think about ESG as almost like a risk mitigating tool. If you don't get ESG right, you're introducing excessive risks into your business. And with those risks, you know, you will be probably trading at a higher cost of capital. Companies won't, you know, financiers won't lend to you, etc. So I think, you know, getting ESG right is just as important as getting production right, getting safety right. It should be absolutely core to the fundamentals of the business. In terms about this question around, you know, creating value for shareholders, value can be created in a whole different range. You know, it could be created through M&A, it could be created through returns, it can be created through growth, it could be created through commodity upsides. So there's a whole different way of doing that. But I think what we've definitely seen and learned over the last sort of 5 to 8 years is, you know, you've got to keep that as the focus, not just grow for the sake of, you know, growing for the sake of growth. So I think ESG is part of a risk mitigating tool, but also is creating opportunities to future growth because of the sort of changing commodity mix, changing demand, etc.
No, thank you. I knew that was implied in what you were answering, but I thought it was just worth, you know, making sure we state that categorically as well. I mean, this morning, our minister, who last year at this time promised us an exploration plan within 3 months, still spoke about the exploration plan 12 months later. He did say two things. This is a national exploration plan. He said two things which I found interesting, because I confronted him with the lowest exploration spent since 1994. A steady decline is the reality of the democracy. 27 years of lower exploration spent in South Africa. He said that he plans to commit to South Africa moving from 1% of worldwide exploration spend to 5%. Sounds like a good political statement. That would be huge. Then he obviously go on to say, and this will be government-led through the Council of Geosciences. And I think I could hear 600 participants collectively sigh. Is there a space in a country's exploration revival for government? And I mean, you all have mentioned that. Brett, Mick, let's start with you. And Fiona, I would even love your comments on this before I get to Olivia. So, Brett, should this be government-led, or should the government just put in place systems and step out of the way and let private money come in?
Yeah, Bernard, I think it's more the latter, where you create the environment for others to do the work. I think that's far more efficient. I worked for RCF in Chile for a number of years, and one of the challenges there is all the majors hold all the land. So the majors will do their exploration for their own benefits, but the little guys find it harder to gain access to ground. In contrast, Western Australia's probably had one of its most profitable mining in years, and yet the government here has increased its funding that it's supporting for exploration here in the state, because they recognise the long-term benefit. And it's probably easier to put that money to work today than when their coffers are more challenging. So I think it's really creating the environment, Bernard. Relying on government to find the next large deposit is reasonably unrealistic, I think.
Mick, you have a similar view, a different view?
Mostly the same. Look, I think you've got to have the system that allows people to invest with some reasonable expectation that they'll get a return one day. But where the government can, and in some countries can do work and has been successful, is like, large-scale airborne geophysics type projects and stuff like that, which the data is then available, for everyone. That helps your real juniors end of the market. Your BHPs and they can afford to do it. But yeah, I'd be amazed if the government, tactically, strategically, can turn around to the population and say, we're going to spend X hundreds of millions of rand a year on exploration, when you've just had riots because people haven't got enough money and huge unemployment. And that unemployment isn't going to get fixed by the government spending this money up front, right? So you create the system that allows people to spend the money. It will get spent. Given the commodity prices, it will get spent.
Yeah, my problem is I so agree with you guys that I can't even contemplate it being a government-led in its true sense of the word, as you've summarised. But ladies, Fiona, I'm sort of paraphrasing what Gwede said, but then half an hour ago, if my read is correct that he wants to make exploration important again, tick, we like. If he thinks it should be government-led, your views?
I wouldn't just sigh, Bernard, like the 600. I would scream in agony. I mean, power he's sitting on, won't let the private sector come in. Oh, dear me, no. And as people get a better appetite for risk again, they will go into the other countries. They'll go back into Zambia. They'll go into the DRC. South Africa, if the government has its heavy hand on everything, it is death.
Olivia, you can just politically correct agree, or you can expand.
I think it's all been said. But I think there's a lot that just host governments in general can do about creating either a stable environment, an incentive-based environment to encourage exploration spending. And then the last thing you want to have is if also you have exploration spending and then you have success, but then you have, an incredibly challenging time permitting. So I think, you've got to almost look at the two of them together because they're so interrelated.
There's a very broad question from Muketsi Max Manoli, and he asks, how do we market South Africa as an investment destination given the current global view of it being uninvestable? Just a quick round, perhaps the one thing you would recommend as the sort of panelists. Olivia, can I start with you? What
Sure.
could South Africa do to become more investable?
Yeah, look, I think I just sort of think back to our own experience. I mean, there's some great. I think ultimately, the success of an asset or a mining company ultimately does come down to the quality of the resource. I think when we look at kind of the resource base in South Africa, there is a lot of high quality assets within that. I think so. Where some of the issues have been in the past has been of the cash that is generated. How much of that actually ends up coming back to a final shareholder? The claims from power, the claims on labour, fiscal instability, etc. So I think creating a stable base which gives confidence to companies to reinvest back into the country, and then when we think about kind of I think power mix is something for me really important. I think that the pressure from sustainability focused investors to actually put quite strict requirements on companies to not produce coal, but actually not to source power from thermal coal is only increasing. So I think that move towards renewable power sources is really key. And then really to, as much as possible, and these are challenging issues, particularly in a country like South Africa, just to have fantastic engagement with your labour force, etc., to try and reduce some of that risk around strike action, huge wage inflation, etc.
Brett, good advice there from Western Australia. Don't talk rugby to us, but you guys in Western Australia at least don't play rugby. So, I mean, that's what I'd say.
I'm Australian. I avoid rugby conversations more generally, Bernard. No, look, we still have assets in South Africa. I think it is a place we've always been attracted to. I would say we're currently probably sitting on the sidelines waiting to sort of get some more confidence around the issues that Olivia's raised. But I'd be very hopeful that we'd be back there, putting more money to work. Again, it comes down to the geological endowment there and the opportunity. And, we've been around sort of almost 25 years now, and we plan to be around for another 25. And over that time period, I think things are resolvable and you'll bring money back into the country. It's not a simple fix by any means, and quite a challenge for the government to bring that confidence, but it's imperative.
Mick, I'm going to add a bit to the question, because 20 odd years ago, when I was the CEO, we were often criticized that as South African CEOs, we were not investing in the country. How could we expect anybody else? You interpret a lot of Sibanye's move as leaving South Africa. Is there a component of that? I mean, should we as South Africans first be prepared to find value accretive investment opportunities in our own country before we can even expect others to join?
Yeah, well, I think so. And I think, Sibanye didn't fully leave South Africa, but, tactically he was looking to be able to have operations outside South Africa so that once, if there was strike action, he had unhedged PGM production in North America. It was a very good tactic, actually. I think, I think it's hard for people to invest in the country when everyone else wants to leave. And in terms of being able to, put that investment in, as everyone said, you need to have a reasonable, stable fiscal environment that you've got some chance that it's not going to get changed on you and that you're going to be able to get your money out. And right now, I still don't see that environment in South Africa. The SPAC that I've raised, is looking for sizable deals, has a global mandate. We really can't do South Africa at the moment.
Olivia, thank you, Mick. A final quick question. So is it you, BlackRock? Is it Mick and his SPAC? Or is it major mining companies who fund the smaller optionality of these green metals? Or should it be the end users? Should it be ultimately the Teslas and the Volkswagens? Who are going to be the funders of the sort of green metals in the early stages?
Yeah, look, maybe it's a cop-out answer, but I actually think it's all three. We're clearly seeing, I think, the end users who are closest to the demand, so let's take, for example, EV manufacturers, I think they can really see the future demand and the shortages that will create. So I think they've clearly they've already sort of moved quite aggressively into lithium, etc. I think to be honest, there hasn't actually been too many SPACs in the mining space. It's a little bit of uncharted territory, but probably the assets that are most attractive to them when they're out raising capital is going to be in these new future-facing commodities. And then I think for the major mining companies, they're going to have some exposure to this space in the future because this is where demand is going to be. So I think it's going to be all of the above.
Guys, out of time, as always. It's all Fiona's fault. She introduces lovely topics and a great panel. Thank you so much for joining us, and thank you for speaking some truths to us as a South African mining industry. Really appreciate it. Thank you, guys.
Thank you, everyone.